Hey everyone, TJ here. Welcome back to another episode of Loans Elevated. Today we're talking about all things jobs. We just got a jobs market report on Friday and it completely flipped the market on its head. Let's dive into it. To start off, the non-farm payroll came back at 114,000 jobs. Now this is a significant miss compared to the expected 176,000 jobs added. To make matters even more surprising, the unemployment rate jumped from 4.1% to 4.3%. Now this is a big shock because economists expected that number to stay flat at 4.1%. Now the question you should be asking yourself is, did the Fed let this cook too long with these high interest rates? I hate to say I told you so, but we've been calling this out for months. Roll the clip.
All these rate hikes getting us up to like the 5.5% Fed funds rate that we're at today, we weren't even really feeling them until fourth quarter of 2023. So we're talking like 5 months ago, we just barely started to feel the effects, economically speaking, of the Fed rate hikes. And it just keeps getting worse. Q1 of this year gets much worse. Q2, Q3 even gets a little bit worse. So we don't even feel the full effects of what the Fed has done over the past couple of years. We don't even feel the full effects until Q3 of this year. So we're like 6 months from feeling the gut punch that the Fed gave to the economy. Haven't even felt it yet. So all of these cracks are forming, things are becoming obvious now, and we've got 6, 7, 8 months until that actually materializes with significance. And then look at our way out. I mean, we don't even hit the feeling we have today again until like Q4 of 2025. So like this is gonna be a long lasting thing. Again, kind of like leading to signs of recession, fear.
And that's why we're getting nervous about headlines, because if headlines keep coming out that employment's doing really good and stuff like that, or inflation's on the rise, then if the vote then goes to raising the rates, which will not happen right now, but if it were to happen, we start feeling the effects.
Or forget it, if they keep rates higher for longer, which we've all heard a ton of that. If they keep rates higher for longer, it's like, so think about this, the higher for longer thing, with the Fed keeping rates high right now, even though inflation has come down, that's a problem. Because inflation is now down, like, so if you look at, there's a website called Trueflation, that is like less than 2%. If you looked at what they're trying to demonstrate what the actual inflation rate is if you looked at data today. Because the government's data, which is what everyone relies on, is a little bit of an antiquated process of how they create the data. And there's obviously tech and data, I mean, that's like the evolution of our world, you know, that there's access to a lot more information. Trueflation is less than 2%, but let's just talk about the government's data. It's at about 3%. Well, 3% with a Fed funds rate of 5.25%, 5.5% is 2.5% higher than the inflation rate. Well, they started hiking this and inflation was at like 7. It was higher than the Fed funds rate. So it was kind of restrictive, but it was still higher. They were trying to drive that down. Now it's tremendously lower, yet they haven't changed the Fed funds rate. So it's like 100% more restrictive, double the restriction on the economy, just because we've seen inflation come down and they haven't changed their stance on borrowing rates, which is forcing everybody to pull back. Does that make sense? So it's worse now. But then TJ mentioned, like, there's some weirdos in the Fed that are saying, hey, we need to keep hiking. Anything like that, or even if they just keep them too high for too long, it's gonna make these get even worse, and it's going to lengthen how bad they get every month or every time they go without dropping rates.
In fact, the market's not just pricing one, but multiple rate cuts by the end of the year. That's right, we're talking about possibly 2 rate cuts in September and 5 by December. This is a dramatic shift in expectations. It really highlights the market's belief that the Fed will need to ease monetary policy in order to support the economy. Now, I don't want this to be all doom and gloom. When it comes to mortgage rates, this higher than expectation unemployment rate is actually good news for mortgage rates. The theory behind this is when unemployment goes up, the consumer spends less. And when the consumer is spending less, that means that inflation is coming down. When inflation comes down, rates follow suit. In fact, we've already seen a small dip in interest rates in just a few short days since this report was released. So if you have any questions, please lean on us. And also, if you've purchased a home in the last couple of years, it might make sense to review a refinance. My team and I would love the opportunity to help out. If you have any questions or comments about this, please leave it in the comments below. We'd love to help out wherever we can.